Hello everybody, some of you might know me, but my name is Dougie Main. I'm an organiser of Unite the Union, and alongside my colleagues Selena Kerr and Daniel Rowantree, I've been supporting Carrie in the wider branch with coordinating this year's pay campaign. We are now asking you guys to vote yes in an upcoming industrial action ballot, and before doing that we wanted to make sure that everybody was up to speed with the financial DNA of the employer, their ability to pay, and what the finances look like over the last sort of 7 years or so. So you can see there on the first slide a wee bit of background on who owns you guys and who the key movers and shakers are. I'm sure you'll be aware of Global Infrastructure Partners, but we've also got the Future Fund and ART, who are essentially wealth fund managers, and their role is to invest in businesses and recoup a return. A fairly standard practice, but there's a wee bit of information there on who they are and what they do, and you guys can read that at your leisure. Crucially for us, what we want to do is we want to get an overview of the business, not only for the last few years we've had the COVID downturn, but how does it look like over the longer term. You can see that since 2015 we've averaged 10.3 million passengers a year, and you guys rank as the 6th busiest airport in the UK consistently. You're the 2nd busiest outside of London, and easily within the top 50 busiest within Europe. And in June 2022, the employer has mentioned that they are at a 93% recovery in the preceding month. So starting to look good again after the tragedy that was the COVID-19 pandemic. How does profit and loss stack up since 2015? You can see there the average profit made per year since 2015 has been £50 million. And that gives us a total profit since 2015 of £350+ million. So even with the COVID pandemic downturn, they're still managing to average a good amount of profit per year since 2015. There is an argument to be made in these things that cash flows sometimes are a stronger indicator of a company's financial health. And you can see there that there's been no issue with positive cash flows even in 2020 and 2021. The average positive cash flow has been £76 million. That's a total positive cash flow over the last 7 years, in nearly £500 million, over £500 million. So, despite the downturn, a very, very healthy company for a long number of years. Where has that money went? Dividends are what's paid out to shareholders, the people that I mentioned at the start of the presentation here. And you can see that the average dividend since 2015 has been £62.5 million. That means a total amount of dividends have been paid out since 2015 of £437 million. They've been paid to the shareholders. Payments to the parent company, who are Green Bidco, who you've seen at the top of the slides. The average payment to parent company since 2015 has been £43 million. A total amount of payments to parent company £304 million. And the cash in the bank has remained healthy. You can see there on the 2021 figures, there was over £50 million in the bank. And then what does that look like stacked up against employee costs? So ultimately, the money they pay you guys to make the airport run, to function, to serve customers, to put the planes in the air, all the functions that you do. And you can see the average employee cost for the last 7 years per year has been £29.3 million, and a total of £205 million. So recapping that, the distributions has been £751.9 million paid out in dividends and payments to parent company. That's in addition to the £300 million profit that they made. And over the last 7 years, the employer has paid out £205 million in labour costs. So what does that look like averaged out? The average dividend per year since 2015 has been £62.5 million. The average payment to the parent company per year has been £43 million. And the average employee cost has been £29.3 million. So in terms of a business model, it's sound for them. They are paying out, they're returning healthy profits on average over 7 years. They are returning healthy dividends on average over 7 years, and they are maintaining average payments to the parent company, which are undoubtedly healthy, and they far outstrip any employee cost, which is ultimately their biggest cost. So it's a very, very sound financial business for them. But what does our pay look like stacked up against that? You see there, quick table on what has happened to our pay. It is 9.4% worse off in real terms than it was in 2018. So that means that your wages, when you go to the shops, when you go to buy a car, when you try to buy a house, when you're trying to, clothe and feed your family, you're getting 9.4% less than you were in 2018, which is why it's absolutely vital that we fight for every single penny that's on the table this year, because if that compounds year on year, even if you are on what may be considered a better wage or an above average wage, that will be slowly ebbed away over the years, which is why it's absolutely vital that everybody votes yes and we make sure that we fight for a fair and just pay rise for you guys, because as you can see there, over the years it's been incrementally chipped away. There has been a few concerns raised about us heading into a recession, and absolutely a recession is an issue, for more so for our members, because we know the additional complications it brings. But we had a look back over what happened the last time the employer experienced a recession, that again we all experienced. 2008, 2009, 2010, 2011, handsome profits posted over an average over the period with 19 million, and passenger numbers remained high. So whilst we absolutely appreciate the headwinds of a recession, it means two different things for us and for them. It will be economic detriment felt by us, and if we base off the performance of last time, they should still remain relatively okay. The employer has also mentioned debt on more than one occasion when we've been in negotiations. So it's good to give you guys a picture of what their accounts said in 2021 on debt. Their total assets are 1.2 billion. Their total short-term debt, so it's debt that's maturing in the next 12 months, is 9.6 billion, which is dwarfed in comparison to, you can see, to their average profits, their average dividends, their assets. So 9 million to us would sound scary, but to a business of this size, it's not as much of a concern. And we've got long-term debt over 350 million. But ultimately, what we do is we stack that up against the debt to asset ratio. And the gold standard, the debt to asset ratio, is about 0.5. You can see this employer is at 0.3, so it's above what would be considered a gold standard on debt to asset ratios. So I hope that answers some of the questions that we've been asked. I hope it gives everybody an overview of what is happening with their pay. And this is the thing I want to finish on. This table is the most important one in the whole entire document. We really need to make sure that we fight for every single last percentage point, because it means what we take home is impacted. I know they're saying that inflation will drop, but ultimately that doesn't mean deflation. It doesn't mean the prices go in reverse. It just means that inflation is compounded over time. This is why it's absolutely vital that everybody votes yes. Everybody encourages their workmates to vote yes, and we make sure we deliver a sound mandate for industrial action. Thanks very much.